Hi friends, Simit here from InformedTrades.com. In this video I want to talk about the key elements of buy and hold investing and how that can work. Of course, I should note that buy and hold investing is not something that everyone is a fan of, but if it's something that you fits your personality or you want to have a long-term outlook, some of the ideas that are presented in this video may be worth considering. Let's get started. Okay, key points. Most of the big moves in the market happen on just a few days, so it's very important to be in the market when those big moves happen. And related to that, these big days tend to happen after market crashes, so it's important to be prepared to have capital ready for when the market does crash. And then third, buy in tranches, and that's sort of related to the second point especially, of just having capital ready for what the right opportunities. And when you get in at the right time, you can really make the most out of a long-term hold. Okay, big moves happen on a few days. This chart here, you can see, at the bottom, fully invested in the S&P 500 from December of 1993, or the end of 1993 actually, beginning of 1994, until the end of 2013. So basically we're looking at 20 years. What happens if you put $10,000 in the S&P 500 in 20 years and you're fully invested? You have a 9.22% annual return. If you miss just the 10 best days, you lose almost half that. A little less than half. You lose a little less than half that. And then miss the 20 best days. You can see that, this is really shocking here. If you miss the 30 best days, you are now at, you miss 80% of the move within a 20-year period. So that's pretty significant. You can see how important it is to be in the market, on just the right days. Now, the flip side, a lot of people argue that buy and hold is not a good strategy. And this sort of plays both ways, because if all the moves are happening on the right days, then really the best strategy might be to just be in the market on those big days and to not be in the market at any other time. However, if you're concerned about the ability to time it properly, the other viewpoint is just stay in the market and wait for those big days. Now, when do those big days occur? Of course, some element of timing is ready, and the big moves tend to happen after big days. This is a bit of a sloppy graphic here, but hopefully it illustrates. And we'll just walk through a few examples here. The crash of 1987 occurred on October 19th. The market fell 20%. The next day, though, October 20th, 1987, 5.33% gain. How about this one? Market crashed in 2008. November 20th, market falls 6.71%. November 21st, market goes up 6.32%. And this is something short-term traders use as well. Well, they'll wait for a big crash, then they'll get in, they'll close it out after just one day. But this illustrates waiting for the big move down. Buy low, sell high. It's obvious, although when the time actually comes, it can actually be difficult to act on it because of all the panic going on. If you retain your poise, if you remember the concept that after a big crash, the market tends to rebound, that can serve you well over the short term or the long term, regardless of what your strategy is. Okay, buy in tranches. Now, if you have an outlook of 10 years, 20 years, for instance, you can still have levels identified that you want to buy at, perhaps that you want to sell at. Right now, this is December 31st, 2014. We are looking at a monthly chart of the S&P 500. And if I wanted to really buy and hold now, you can see the market has really run away. But you can sort of identify major levels, and this is where, fluency with technical analysis and just basic ideas of support and resistance, measuring Fibonacci pullbacks can be really useful. You can say, well, there's a major top here at 1546. We saw that at the turn of the millennium. We saw that at the 2007, right before the market crash. If the market pulls back to that level, that could be an interesting level to buy at. We also see a bottom at 785. The market bottomed here in 2003. It bottomed a little below that in the crash in 2009, 2008, 2009. So you can sort of identify, here's one, you have a long spike off this level, so maybe you will have a little bit of capital here at 1837 just to get a little foot in the market, have some more capital ready for 1546, and so on and so forth. So buying in tranches basically means when you enter, you don't put all in, you have some capital ready specifically for a market crash. And that ties into our previous point, right? If the big moves happen after big down days, you want to be ready for those days when they occur. If the market crashes to 1546, you want to have some capital ready to buy. If it crashes to 1100, you want to have capital more ready to buy. So planning your trade and having a strategy to buy in tranches can fit into a long-term buy and hold overall strategy. Of course, like I mentioned at the outset of this video, there is a flip side. Not everyone is a fan of buy and hold investing. However, it can work, and it is important ultimately to sell. You do have to buy low and sell high. So buy and hold is an expression, and perhaps not the most useful one, because you really do have to, you can't just hold forever. You do have to sell at some point. So identifying when you want to sell, some profit targets, and a little bit of technical analysis, Fibonacci extensions, can help with that support resistance. And we have, of course, a lot of information on Informed Trades about that as well. Just wanted to give a quick overview of some of the key concepts here. Any questions you have, anything you want to add, join us at informedtrades.com. Best of luck in your trading, and we'll see you next time. Take care.